Dividend investing is a powerful strategy that's been embraced by seasoned investors seeking a reliable source of income and steady growth. Unlike traditional investing, where profits primarily stem from capital appreciation, dividend investing focuses on generating returns through dividends paid out by companies to their shareholders. These dividends represent a portion of the company's profits, distributed regularly to investors as a token of appreciation for their ownership. At its core, dividend investing offers a dual advantage. It provides a passive income stream while allowing investors to participate in the potential long-term growth of the invested company. Beyond the conventional wisdom surrounding dividends, several lesser-known aspects of this investment approach can significantly impact an investor's portfolio and financial goals. Hey, welcome back to the channel. Today, we'll be discussing 5 things about dividend investing that most of you aren't familiar with. This video's for all you investors out there, so watch till the end to find out the most important thing. When it comes to dividend investing, several key factors and concepts are necessary to know to make informed decisions and maximize your returns. Here are 5 things you didn't know about dividend investing. Number 5. Dividend capture strategy. The dividend capture strategy is an investment tactic used by some traders and investors to take advantage of dividend payments from stocks without holding those stocks for an extended period. The goal of this strategy is to capture the dividend income while avoiding a long-term commitment to the stock, allowing investors to recycle their capital quickly to potentially generate more income. To implement the dividend capture strategy, it's crucial to understand the key dividend dates. The declaration dates when the company's board of directors announces the upcoming dividend amount and payment date. The ex-dividend dates typically 2 business days before the record date. Investors who purchase the stock on or before the ex-dividend date are eligible to receive the dividend. The record dates when the company determines the list of shareholders eligible to receive the dividend, while the payment dates when the dividend's paid to eligible shareholders. The investor identifies dividend-paying stocks that are about to go ex-dividend soon. The idea is to buy the stock just before the ex-dividend date to qualify for the dividend payment. The holding period for stocks in the dividend capture strategy is relatively short, typically ranging from a few days to a few weeks. After purchasing the stock, the investor waits for the ex-dividend date to arrive. On or after the ex-dividend date, the investor becomes eligible to receive the dividend payment. Once the dividend's received, the investor sells the stock. The dividend capture strategy sounds appealing, but comes with several risks and considerations. Short holding periods expose investors to market volatility, which can lead to unpredictable price swings, potentially resulting in losses. Additionally, after the ex-dividend date, the stock's price may drop by an amount equal to the dividend payment, negating any gains from the dividend. Frequent buying and selling of stocks can lead to increased transaction costs, reducing the overall profitability of the strategy. Furthermore, depending on the tax laws in the investor's country, dividends and capital gains may be subject to taxation, impacting the net returns. Number 4. Dividend sustainability and safety. Dividend sustainability and safety are critical factors to consider when engaging in dividend investing. Sustainable dividends are those that a company continue to pay over the long term without jeopardizing its financial health. A sustainable dividend indicates that the company generates enough profits to cover its dividend payments and has a healthy balance sheet. Investors should look for companies with a reasonable dividend payout ratio, which measures the percentage of earnings paid out as dividends. A low payout ratio suggests that the company retains a significant portion of its earnings for reinvestment or other purposes, making it better equipped to weather economic downturns and maintain dividends even in challenging times. On the other hand, an excessively high payout ratio might signal that the company is stretching its financial resources to sustain dividends, which could be unsustainable in the long run. Dividend safety goes hand in hand with sustainability and refers to the stability and predictability of a company's dividend payments. Companies with a history of consistent dividend payments, especially during economic downturns, demonstrate a higher level of dividend safety. Robust cash flow is another indicator of dividend safety. Companies generating ample cash flow can meet their financial obligations, including dividend payments, without relying heavily on debt or external financing. Investors should also evaluate a company's ability to maintain dividends in various economic scenarios, taking into account potential industry-specific risks and market conditions that could impact the company's operations and profitability. While dividend sustainability and safety are crucial aspects, it's important to remember that no investment is entirely risk-free. External factors such as economic recessions, changes in industry dynamics, or unexpected financial challenges can affect a company's ability to sustain dividends. Therefore, investors need to conduct thorough research, assess a company's financial health and growth prospects, and diversify their dividend portfolio to mitigate risk. Number 3. Dividend ETFs and funds. Dividend-focused exchange-traded funds, ETFs, and mutual funds provide investors with a convenient and diversified way to participate in dividend investing. These funds pool money from multiple investors to invest in a portfolio of dividend-paying stocks, offering exposure to a broad range of companies and industries. Dividend ETFs trade on stock exchanges like individual stocks, making them easy to buy and sell throughout the trading day. Mutual funds, on the other hand, are bought and sold at the fund's net asset value, NAV, at the end of the trading day. Both options provide investors with instant diversification, reducing the risk associated with investing in individual dividend stocks. Dividend ETFs and mutual funds come in various types and strategies. Some funds focus on high dividend yields, while others concentrate on companies with a history of increasing dividends over time. Dividend aristocrats or dividend achievers. The selection of the appropriate fund depends on an investor's investment goals, risk tolerance, and preferences. Additionally, these funds may have different expense ratios, which are fees charged to cover the fund's operating expenses. Lower expense ratios are generally preferred, as they leave more of the fund's returns in the hands of the investor. Number 2. Foreign dividend stocks. Foreign dividend stocks refer to shares of companies that are based in countries other than the investor's home country and offer dividends to their shareholders. Investing in foreign dividend stocks allows investors to diversify their portfolios internationally and potentially benefit from the growth and income potential of companies operating in different economies. However, it also comes with unique considerations and risks. One of the key benefits of investing in foreign dividend stocks is the opportunity to access a broader range of industries and markets. Different countries may have sectors that are thriving and offer higher dividend yields compared to those in the investor's home country. Moreover, international exposure can be advantageous during times when domestic markets are underperforming. It provides a hedge against country-specific risks and reduces the impact of any single country's economic downturn on the overall portfolio. It's crucial for investors to carefully assess the risks, be mindful of currency fluctuations and tax implications, and ensure that foreign investments align with their overall investment objectives and risk tolerance. A well-considered approach to foreign dividend investing can enhance a portfolio's resilience and potentially boost returns over the long term. Number 1. DRIP fee and partial shares. DRIP, Dividend Reinvestment Plan fee, and partial shares are two important aspects to consider when participating in a dividend reinvestment plan. DRIPs allow shareholders to automatically reinvest their dividends back into the same company's stock, rather than receiving the dividends in cash. It's a powerful way to compound returns over time and acquire additional shares without incurring additional trading fees. However, some companies may charge a DRIP fee for this service. The DRIP fee is a small transaction fee that's deducted from the dividend payment before reinvesting the remaining amount to purchase additional shares. Investors should be aware of the DRIP fee's cost, as it can impact the overall returns and should be factored into their dividend investment strategy. Partial shares are another important consideration in DRIPs. When dividends are reinvested, the resulting amount may not be enough to purchase a whole share of the company's stock, especially if the stock's price is relatively high. In such cases, the investor is eligible to receive fractional or partial shares, representing the portion of a share that their dividend amount can buy. Over time, these fractional shares can accumulate, leading to the acquisition of whole shares. Partial shares in a DRIP allow investors to take full advantage of their dividend income and compound their returns more effectively. That's all for today. Make sure to like the video and share it with your friends who you think might be interested. Also, don't forget to subscribe so you get a notification every time we post a video. Until next time, thanks for watching.